of at at the point at which the company, the transaction closed, Twitter was tracking to lose over $3 billion a year. And had $1 billion in the bank. So that's 4 months to death. So this is your starting position. How would you feel? Pretty intense, you know.
You also had to borrow quite a lot of money and pay interest on that too.
Well, that's why part of why it was the $3 billion run rate. So, in rough numbers, a normal year, Twitter would do, say, let's say $4.5 billion in revenue, $4.5 billion in cost. I mean, it was really kind of like a non-profit. They'd run it at roughly break even. Now,
but that's not a bank. That's not bankruptcy. You're not saving that company from bankruptcy. No, it's breaking even.
But then the issue is that if you then add $1.5 billion in debt servicing, and have a massive drop in revenue, which we did, which was partly cyclic and partly, political concerns and whatever. So revenue, call it dropped by over a third. It's not, and this is not just Twitter. Facebook and Google have also seen some significant advertising revenue declines. It's been a little higher at Twitter, but most of the advertisers are coming back. So I think we'll be back where there's a cyclic demand drop, which is still pretty significant. But in rough numbers, revenue dropped from $4.5 billion to $3 billion, and expenses went from $4.5 to $6 billion, creating a $3 billion negative cash flow situation, and Twitter having $1 billion in the bank. That's 4 months to live. So unless drastic action was taken immediately, this company's going to die and be owned by banks.
Let's talk about that drastic action, because almost immediately you sacked a lot of Twitter workers.